So you've done the hard part. You've disciplined yourself, you've scrimped and saved, and now you've got a nice little pile of cash. But let's be real, it's probably just sitting in a bank account, collecting dust and earning practically nothing. You know, deep down, that just saving money isn't going to make you wealthy. Meanwhile, it feels like the rich are all playing a different game, with a secret playbook that turns every dollar they touch into a wealth-building machine. They seem to follow a special set of rules that transforms their cash into assets that grow and spit out more cash. Everyone else, we're just trying not to spend what we've managed to put away. Before we begin, if you want more simple strategies on building wealth, investing, and financial freedom, make sure you hit that like button and subscribe. It really helps the channel, and more importantly, it helps you stay consistent with learning how money actually works. Well, in this video, I'm going to give you that playbook. We're going through the exact, step-by-step methods the wealthy use to turn their savings into powerful investments. We'll cover the super beginner-friendly strategy you can start today, and we'll even get into the exclusive tactics the top 1% use to put their wealth into overdrive. This isn't about getting lucky, it's about following a framework that's proven to work. The foundation beginner-friendly methods all right. Before we get to the flashy, advanced stuff, we have to build the foundation. This is what separates the real investors from the gamblers. The wealthy don't throw money they can't afford to lose into risky bets. They build a financial fortress first. Step 1. Build your fortress. The first, most critical, non-negotiable step before you even think about investing is building your emergency fund. This is the single most important piece of financial armor you will ever own. We're talking about 3 to 6 months of your essential living expenses, tucked away somewhere safe and easy to get to. This is not investment money. It is not, ooh, a cool opportunity money. This is your survival fund for when life does what life does. A sudden job loss, a medical bill out of nowhere, or your car deciding to quit on you. Why is this the very first move in the playbook? Because the number one reason people lose money in the market is that they're forced to sell at the absolute worst time. When the market takes a nosedive and everyone's panicking, people without that cash cushion have to sell their investments at a loss just to cover a surprise bill. Your emergency fund is what protects your investments from your own life. It gives you the freedom to think long-term, which is where the real money is made. So, where do you stash this cash? Not in your regular checking account that pays 0.0% interest. You put it in a high-yield savings account or a money market fund. As of early 2026, many of these accounts are offering yields somewhere between 3.5% and 4.5%, and some are even higher. This way, your safety net is at least keeping up with inflation, or even beating it, while you get ready to put your other money to work. Once that fortress is built and fully funded, every single dollar you save after that is ready for its real job, investing. Quick pause for 1 second. If you're getting value from this and you genuinely want to learn how money actually works, hit that subscribe button right now. Most people spend years figuring this stuff out the hard way, but here, we break it down step by step so you can build real wealth without the confusion. All right, let's keep going. Step 2, the two-bucket system. Once your fortress is secure, the next step is a mental game, but it's incredibly powerful. The rich have a knack for mentally separating their money. You need to adopt this two-bucket system. Bucket 1 is your safety money. This is your emergency fund, plus any cash you're saving for big goals in the next 5 years. Like a down payment on a house. This money's job is stability. It's not there to make you rich. It's there to make sure you don't become poor. For most people, this bucket is just cash and maybe some super safe low-risk bonds. Bucket 2 is your growth money. This is the fun bucket. This is the money you'll use to build actual, long-term wealth. You have to be mentally prepared to see this money bounce around, because its job isn't to be stable. Its job is to grow over a long time. This separation is everything, because it pulls the emotion out of investing. When the market has a terrible week, you won't be tempted to panic sell, because you know your safety money is completely untouched and safe. This simple mind trick gives you the discipline to let your growth money do its thing for decades. For a beginner, a classic split inside your growth bucket might be 60% in stocks and 40% in bonds. The wealthy, however, have a growth bucket that looks a bit different. They often have over half of it in what's called alternative investments. We'll get to that in a bit. But the core idea is exactly the same. Separate the money you need to keep safe from the money you want to grow. Step 3. Start small, build the habit, and automate everything. You do not need a mountain of cash to start investing. In fact, thinking you do is one of the biggest mental blocks that keeps people stuck in the saver phase forever. Today, you can get started on most brokerage platforms with as little as $50 or $100. The goal at the beginning isn't to strike it rich overnight. The goal is to build the habit of investing consistently. Your habits are infinitely more important than trying to time the market. This is where a brilliantly simple strategy called dollar cost averaging, or DCA, comes into play. All it means is you invest a fixed amount of money on a regular schedule, like $100 every single Friday, no matter what the market is doing. When the market is up, your $100 buys a few less shares. When the market is down, that same $100 buys you a whole lot more. Over time, this smooths out your average purchase price and dramatically reduces the stress of market volatility. It basically automates your success and frees you from the impossible task of guessing the market's next move. So, what do you buy? The easiest and most effective starting point for almost everyone is a low-cost, broad market index fund or an ETF. Think of funds like VOO, which tracks the S&P 500, or VTI, which covers the entire U.S. stock market. This is the exact strategy that investing legend Warren Buffett has recommended for most people for years. With one purchase, you instantly own a tiny piece of hundreds, or even thousands of companies. You get massive diversification, and you're basically harnessing the growth of the entire economy. Now here's where the magic happens: compounding. Let's say you invest just $500 a month into an S&P 500 index fund. Based on historical averages of around a 10% annual return, after 30 years, you'd have nearly $700,000. And the insane part, you only put in $180,000 of your own money. Over $500,000 of that is pure growth from your investments. That is the awesome power of turning small, consistent savings into a wealth machine. The acceleration exclusive wealth strategies, okay, those first 3 steps are the bedrock. Honestly, if you just did those 3 things consistently, you would end up wealthier than the vast majority of people. But the truly rich, they have another gear. They don't just invest what's left over from their savings, they hit the accelerator with 2 more powerful steps. Most people never learn this because nobody teaches it in school. So if you want practical wealth-building strategies explained simply, subscribe now. The goal here is simple: help you think and invest like the wealthy. Now let's move to the next step. Step 4. Invest in your income. This right here is the biggest mindset shift between the middle class and the wealthy. Most people see their job as their only source of income, and they invest whatever is left. The rich know that the single greatest wealth-building tool they have is their own ability to earn more money, so they invest in their income itself. What does that actually look like? It means spending money on things that will directly boost your earning power. This could be buying a course to learn a new skill, getting a certification, or even going back to school to qualify for a huge promotion or a career change. It could also mean starting a side hustle or a small business that brings in a second income stream. Think about it. An 8% return from the stock market is fantastic. But a 50% return on a $2,000 skills course that helps you land a $10,000 raise, that's infinitely better. The wealthy see that as their primary investment. The extra income that comes from it then gets funneled right back into their growth bucket, creating a powerful feedback loop. More income means bigger investments, which grow faster and create even more wealth. They don't just invest their paycheck, they invest in their ability to earn a bigger one. Step 5. The keep you rich assets. Once the wealthy have built a powerful income engine and a solid foundation in public markets like index funds, they move to the final stage. Assets designed for explosive growth and generational wealth preservation. This is where that alternative investments category really comes into play, according to major firms like J.P. Morgan. The ultra-wealthy often allocate nearly half of their entire portfolio to these types of assets. This includes things like real estate, and they're not just buying their own home. They're buying rental properties where tenants pay the mortgage, building equity for them month after month. Real estate can provide steady cash flow, awesome tax benefits, and long-term appreciation. Private equity and venture capital. This is about investing in private companies before they are available on the stock market. They're funding the next wave of game-changing startups. It's definitely risky, but it offers the potential for the kind of astronomical returns you just can't find in public markets. These assets are often illiquid, which is a fancy way of saying you can't just sell them tomorrow like a stock, but that's part of the strategy. They are rewarded with much higher potential returns for providing that long-term, patient capital. And while these worlds used to be completely closed off, they're slowly becoming more accessible to everyday investors through things like REITs for real estate or equity crowdfunding platforms for startups. The key thing to remember, though, is that this is the final step of the playbook, not the first. The wealthy use these assets to accelerate and protect their fortune, but only after they've built their fortress, mastered their investing habits, and supercharged their own income. So let's quickly recap the 5-step playbook the rich use to turn savings into a fortune. First, you build your impenetrable fortress with a 3-6-month emergency fund. Second, you set up the 2-bucket system, separating your safety money from your growth money. Third, you start investing small, consistent amounts into low-cost index funds, building the habit and letting compound interest work its magic. Fourth, you make the crucial mindset shift and start investing directly in your own income. And finally, once you've done all that, you explore the keep-you-rich assets like real estate and private investments to really accelerate your growth. Saving money builds a financial floor under your feet, but disciplined investing is what builds the skyscraper. The difference between having a little bit of money tucked away and achieving true financial freedom lies in following these steps. Now, I'm curious, where are you on this journey? Are you still in the saving stage, building up that fortress, or have you already started investing? Let me know in the comments below which step you're currently working on. And if you found this playbook helpful, do me a favor and hit that subscribe button for more actionable strategies to help you build lasting wealth.